Hello everyone and welcome back to TradeSMart, where we test objective rules-based strategies and code the best ones into TradingView trading scripts to help you automate your trading. Today I'm excited to reveal a powerful tool, or latest Premium TradingView Script, which is based on a smart money concept focusing on fair value gaps. If you don't already know what fair value gaps are, let me quickly explain it with an example. Here on the chart, as you can see, the price has touched this level multiple times, indicating a strong support level. A retail trader would typically enter into a long position near this level, placing their stop loss just under the support area and targeting the recent high points. Now watch what happens next. At first, the price bounces off of support level, just as the retail trader would expect, but then it turns around and enters into a sideways range. Later, the institutions move the price below the support level, stopping out the retail traders. But that's not all. What a retail trader will do now is enter into a short trade as the price broke a strong support level. Most likely they would place the stop loss at the recent swing high and target the previous support levels. Now let's see what happens. The price starts to move down just as expected, but then stops and reverses. A bit later, smart money traders and institutions drive the price up, hitting the stop losses of the retail traders. But why do institutions do this? Institutions have their own orders to fill, and their orders are much larger than those of retail traders combined. In order to fill these big orders, they need to drive the price to levels where retail traders place their stop losses. These areas have a lot of liquidity, which is a perfect target for big institutions. Once they hit the stop losses of retail traders, their big orders are being filled. Now you know a simple smart money concept. But how do we take advantage of it? What do you see in this price action that screams that there might have been an institutional price manipulation? What about, for example, this huge red candle? When you see big one candle moves like this, it is usually a result of institutional price manipulation. These manipulations usually create fair value gaps. Fair value gaps are created when the price moves so quickly that many orders are left behind unfilled. Institutions tend to push the price back to these gaps to fill the unfilled orders, and we can place a position that targets these fair value gaps. Our new script, which I'm about to show you, is designed to take advantage of these fair value gaps, and besides that, you can set it up as a trading bot. So in this video, I will explain the strategy and show you how the script works. Then I will show you two optimizations. The first is the original strategy I came up with for crypto, and the second is made for Forex. So even if you don't want to use our premium scripts, watch this video as I will explain you how you can trade the strategy manually and show you which are the best assets to trade it with. But if you like the script and want to try it out, you can get access to this and to all of our other premium TradingView scripts and optimizations by becoming one of our Smart Trader tier supporters on Patreon. Without wasting any time, let's get right into it. First, let's go over quickly the indicators needed to trade it manually and the rules of the strategy. For this strategy, first of all head over to TradingView and set up the BTC USDT 1 hour chart. Once you got that, open up the Indicators tab and let's add our indicators. The first indicator is going to show us where are those fair value gaps we want to trade. So for that, type in imbalance and add this one to the chart. The second indicator is going to be our stop loss indicator, and it is the well-known NNFX ATR. Add this one to your chart. And finally, for this strategy, we will only use one extra filter, which is going to be an ADX with an EMA. So type in ADX and add this one to your chart. And type in EMA. And click on this one. Now we have to change some settings, so let's start with the imbalance detector. Here you only want to leave the fair value gaps ticked, so untick all the other ones. And you can change its color to anything you like. I will use white and yellow. Finally, tick this min width box, give it a 0.3 value, and change it from points to percentage. Why we needed to do this is because there are some naturally occurring imbalances, but those imbalances are usually very small, less than a 0.3%. By giving it a limit of 0.3%, we eliminate those naturally occurring fair value gaps and only leaving the ones which are big enough to be considered as a price manipulation. Next up, let's modify the ATR settings. For the X value, which is the ATR length, give a 50 value. And for the SL, leave it at 1.5. Go into the style settings, untick the buy TP, the sell TP, and the main ATR. Finally, change the line styles to step line. Now these red lines are going to be our stop loss placements. Finally, let's set up our ADX indicator. For that, first of all, click on the EMA and start pulling it down until you reach the ADX. Once you're there, release it. This way the EMA will be displayed on the ADX indicator. Now go into the EMA settings, change its length to 5, and change the source to ADX. Then if you want, you can change its color. I usually use white, but it's totally up to you. Finally, go into the ADX indicator settings, change the smoothing to 50 and the DI length to 50. And with that, our chart is all set. Now let's go over the rules for long and short entries. Okay, here you can see a valid long entry. For a long entry, first we need to see a red candle that creates a fair value gap. So if you see a yellow box, that is going to be a red candle with a fair value gap. After that, immediately the next candle needs to be green. So if this candle would have been red, we wouldn't trade this fair value gap. Finally, the ADX needs to agree with this position too, and the rule for the long entry is the following. For a valid long entry, we want to see that the ADX line, which is the red line, is under the white line, which is the ADX-based EMA. And as you can see here, that's the case. So we can enter into a long position at the close of this candle or at the open of the next candle. Stop loss will be placed at the lower NNFX ATR line. And we are targeting the top of the box, so we want to see that the price covers the whole fair value gap. There's one extra rule I added because of trading fees. That rule is the following. If the middle point of this fair value gap has not created a risk to reward ratio of at least 0.2, then we wouldn't trade this fair value gap. That's because a 0.2 or lower risk to reward ratio is not worth the risk of losing the whole trade. But in this case, the risk to reward ratio at the middle point is higher than a 0.2, so it is a valid trade. And as you can see, the take profit level was hit right there. Okay, here is a valid short entry signal. For a short entry, we want to see a green candle that creates a fair value gap, which is highlighted with this white box. Right after that fair value gap, we want to see a red candle. So if this would have been green, we wouldn't trade this fair value gap. And finally, the ADX needs to agree, which means that the ADX line, which is the red line, needs to be under the white line, which is the ADX-based EMA. As you can see, that is the case, so we can enter into a short position. Stop loss at the upper NNFX ATR line. And the take profit will be placed at the bottom of the box. But again, let's check if the middle point creates a 0.2 or higher risk to reward ratio. And as you can see, it's just above 0.2, so we can take this trade. And as you can see, this was another successful trade. Now let me show you how our new fair value gap premium script works and how you can set up the original strategy with it. To explain all the functionalities, we will use this valid short position. If you are already one of our Smart Trader tier Patreon supporters, open up TradingView, then go to the Indicators tab, then to the Invite Only section, and here you will find our fair value gap premium strategy. Add it to your chart. Now let's open it up, and here you can see all the functionalities you can set, modify and change. There are a lot, but we won't go over most of it, because I already explained it in another full TradeSMart Premium Script tutorial video. I will leave a link to that in the description. Today we will only focus on the basic logic settings of this script, as all the other are just the same as in our other premium scripts. Let's get started. On the top, our first option is to plot fair value gaps. If you tick this box, then the fair value gaps are going to be printed like this. Here you can set for how many candles you want to print a fair value gap. So as you can see, this is set to 3. And that's because after the fair value gap has formed, we will see the plottings till 3 other candles. The next section is the minimum fair value gap area section. Here, just like anywhere else, you will have a tooltip, which I recommend you read because all the functionalities are described in these tooltips. With this function, we can decide how big a fair value gap needs to be to consider it as a real fair value gap. In the original strategy, it is set to 0.3%. If you click on this section, you can see three different options: pips-based, percentage-based, and ATR-based. Let's go over them one by one using this fair value gap. First, using the date and price range tool, let's measure how big this fair value gap is. From bottom to top, in height, it's around 1.19% or around 330 pips. So, if we don't want to consider this fair value gap as a valid fair value gap, first we have to switch to pips, then we have to give a higher value than 330 pips, and we wait till the script is loaded. And now, as you can see, no trades are happening here and the fair value gap isn't plotted. But if I give this a 300 pips value and wait until the script is loaded, this fair value gap will be considered as a valid one as its height is 335 pips. And as you can see, it reappeared. Okay, switching to the percentage. If I want to exclude this fair value gap, I have to give the minimum percentage area a higher value than 1.19%. So let's give it around the 1.5. If I give it a 1.5 and wait until the script is loaded, as you can see, there are no trades happening here. If I want to allow this fair value gap, I have to give it a lower value than 1.19%, so let's give it a 1%. Let's wait till it's loaded. And as you can see, it is again considered as a real fair value gap. We have the last option here, which is the ATR-based. The reason why we included the ATR-based version is for you to be able to create an optimization that works on multiple timeframes. That's exactly what I did with the second optimization that I will show you at the end of the video. If we read the tooltip, you can see that the ATR method works as follows. The height of the fair value gap must be higher than the ATR times the set value. So for this we will need to use an ATR indicator. Let's add it to the chart. Back to the script. Okay, in pips the height of this fair value gap is 335. So if we want to exclude this fair value gap, we need to type a value here that is, after multiplied with the fair value gap's ATR value, will be higher than the fair value gap height itself. I know it's a bit complicated, but let me show you how it's done. So the fair value gap was created on this candle. On this candle the ATR value was 211. So if we want to exclude this fair value gap, we need to multiply the 211 with a number that is higher than the fair value gap's height, which is 335 pips. If we multiply 211 by 2, it will be 422, which will be higher than the fair value gap's height. So let's try it out. First, make sure that the ATR length is set to the same as the one you have on your chart, which is 14. And that the smoothing is set correctly. And let's type here a 2 value. Okay, now let's wait till the script is loaded. And as you can see, that fair value gap is not considered as a valid one. But if we want to allow it, now let's multiply the ATR value with 1, which will result in a 211 limit. And as this fair value gap's height is 335, the script will allow it. Let's wait till it's loaded. And as you can see, it reappeared on the chart as it is considered as a valid one. Okay, now you know how to limit your fair value gaps based on its height. For the original strategy, we will need to use a 0.3%, so let's set it up and let's move on. The next option is the entry type. Here you can choose from two different options. First is the just after fair value gap, and the second is on the first opposite direction candle. If you select the just after fair value gap option, then the strategy can only enter into a short position if we get a red candle immediately after the fair value gap was printed. So if this candle would have been green, this whole setup would have been invalid. Similarly, at a long position, if the just after FVG is selected, we could only enter into a long position if after the fair value gap we get a green candle, just like what you can see here. If you choose the other option, which is the on first opposite direction candle, then the strategy will be able to enter into a short position, even if after the fair value gap candle, which is this one, the first candle wasn't a red one. But it will enter on the first red candle. Opposite goes for long positions. Moving on, we have the reset type option. The reset type option can only be used if the entry type is set to the first opposite direction candle. Here you have two options. If we read the tooltip, it says that if on the first opposite direction candle is selected as the entry type, in that case, an active search for opposite direction candle is set when an FVG is detected. The search will end on an opposite FVG signal if on opposite direction FVG is selected, or after a number of candles set with the reset candle number if the after X number of candles is selected. With this option, you can basically set up when the strategy will stop looking for the entry conditions. For instance, let's take this example. Here we got the fair value gap, but the next candle was green, so the strategy is still looking for a red candle to enter. If the on opposite direction FVG is selected, the script won't stop looking for a red candle until an opposite direction fair value gap is printed. On the other hand, if the after X number of candles is selected, and for example the reset candle number is set to 3, then the strategy will stop looking for a bearish candle if in the next 3 candles after the fair value gap candle there are no red candles printed. Here we can try it out. So if I set this to 1, then this trade will be eliminated as soon as the script is loaded, because the candle after the fair value gap wasn't a red candle. And as you can see, that is the case. Before moving on, for the original strategy, we will need to use an entry type of just after FVG, and the reset type doesn't matter, so you can leave it as it is, because this is only activated when the on first opposite direction candle entry type is enabled. Next option is the FVG based take profit percentage. Here you can set where you want to place your take profit. In the original strategy, the take profit was to cover the whole fair value gap. For example, here you can see this is the bottom of the fair value gap and this is the top of it, and the take profit level is set to the bottom of the fair value gap. But here we can modify it. So for example, if I want to exit the position at the middle line, so at 50% of the fair value gap coverage, which is right here, then I will have to add a 50% value here. Let's wait till it's loaded. And that's correct. Now the take profit level is set to the middle of the fair value gap. You can also target more than the fair value gap coverage, as usually the price will move further than the whole fair value gap coverage. So let's set it, for example, 150%. Let's wait till it's loaded. 150% will be somewhere around here. And yes, that's exactly where it's placed. Interestingly, in the second optimization, I found that the 300% target works the best. So if you want to use the fair value gap based take profit target, make sure that the box next to it is ticked. Otherwise, the script will use the original exit strategy, which you can set up here. Again, I won't be explaining this section. I will leave a link in the video description that will lead you to the full Premium Script tutorial video. Before moving on, let's set this take profit target to what we used in the original strategy, which is the full fair value gap coverage, which is 100%. In the next section, you can limit the minimum risk-to-reward ratio that a trade needs to have in order to be considered a valid entry. In the original strategy, we used a 0.2% minimum risk-to-reward ratio, and let me show you how it's calculated. So once we have a valid short entry, set up your stop loss, which should be right here, and target the middle line of the fair value gap. If in this case the risk-to-reward ratio is lower than the set value, which is currently a 0.2, then the entry won't happen. But as you can see, it is now a 0.61. This will be a valid entry. The reason why we added this function is because sometimes the fair value gaps will be very close to the entry level, while the stop loss is relatively far from it. This way, by using fees, it doesn't worth the risk to enter into a position with a very low risk-to-reward ratio. And the final option is the price rebound filter. At first look, this looks like a complicated option, but you will get the hang of it really quickly. You can only use this when the entry type is set to on first opposite direction candle. If enabled, a percentage-based price rebound value will be calculated on the potential signal candle. If this value is higher than the set value, then the entry won't happen. For example, let us have a fair value gap with a minimum of 50 and a maximum of 200. These are price levels. If the highest value of the potential long signal candle is 125, then the rebound percentage is highest value of candle minus minimum of fair value gap divided by length of fair value gap times 100. So 125 minus 50 divided by 150 times 100, which is 50%. The idea behind this filter is that a fair value gap is only a good target until it hasn't been filled. If the entry candle has already wicked through the whole fair value gap, it means that all the orders that were there has been filled. So it might not be a good entry anymore. I hope with the help of the illustration this function is clear. In this example, the price rebound value is 50%, so if you want to eliminate a position like this, you had to set the price rebound filter to a lower than 50 level. And if you want to allow it, you have to set it to a higher than 50 level. And one last thing before wrapping it up, we had to modify the ADX limiter, because in the original strategy we used an ADX limiter, but not in the usual way. Here, as you can see, for a valid short entry, the ADX needs to be lower than the ADX-based EMA. So let's set that up in our script. First, tick the Use ADX Limiter function, then set this limiter to normal, set the low boundary to 0 and the high boundary to 100. And finally, this is the part we modified. Here at the Use MA-based calculation, set the ADX must be lower than the set MA. Then set up the EMA and a 5 length to the AMA. This part is basically what you can see here. Here we have the red line, which is the ADX value, and the blue line, which is the ADX-based moving average. For every entry, shorts and longs too, in the original strategy, the ADX value needs to be lower than the EMA. And basically this is how you can set it up. Okay, now you know all the new functions that this fair value gap strategy has. Now, before showing you the results of the best asset timeframe combinations I found, let me quickly show you how the second optimization is set up. For the second optimization, which is made for the Forex pairs, I used the 0.4 ATR setup for the minimum fair value gap area with an ATR length of 25. The entry type is set to the first opposite direction candle, and the reset type is set to after X number of candles, and the X value is going to be 3. For the FVG based take profit percentage, as I said earlier, I found that the 300% times the fair value gap is the best, and I didn't use any other filters, not even the ADX limiter. But as you can see, it gave pretty good results. I'm sure that with some time and effort, you can even get a better optimization. And now let me show you two optimizations of this script. One is almost the same as the original strategy with slight differences because of TradingView limitations, which works best on crypto. And the other is best on Forex. First, let's see the original strategy. The basic optimization works best on the BAT USDT 1-hour chart. Also, if you want to check the results for yourself and get access to all of our premium scripts, head over to our Patreon page and become a Smart Trader tier member. Link is down in the description. Between 2019 and 2023, with a 4% risk per trade non-compounding position sizing, fees included, and with an extra filter which excludes trades on Thursdays, this strategy took 519 trades, generated 155% net profit with a 1.229 profit factor and a 17% maximum drawdown. The equity curve is stable and has a nice uptrend. However, as I didn't use almost any of the filters that our scripts have, I'm sure there is room for improvement. The next asset, which gave good results too, is the 1-inch USDT pair. On 1 inch between 2020 and 2023, using a 3% risk per trade non-compounding position sizing, with fees included and without the valid trading days limiter, this strategy took 308 trades, generated 77% net profit with a 1.26 profit factor and with only 15% maximum drawdown. The equity curve is not as stable as the BAT USDT, but it still has some potential. The last crypto pair, which is a good fit for this strategy, is the Cake USDT pair. On Cake, between 2021 and 2023, using a 5% risk per trade non-compounding, without the day filter and with fees, The strategy took 280 trades, generated 112% net profit with a 1.24 profit factor and with 18% maximum drawdown. This equity curve has great uptrending periods, but there are a few flat periods too. And at the end, it is underperforming. Out of these three assets, I would go with BAT USDT as it gave the best equity curve, but of course, this and none of our other content is financial advice, and we are not financial advisors. Okay, now let's go over the second optimization, which was made for Forex pairs. With this optimization, my aim was to create an optimization that is a good fit for multiple timeframes and assets. To achieve that, I used an ATR-based fair value gap limiter instead of the percentage-based one, which I used in the first optimization. This way, as the ATR adapts to every time frame and is not a fixed percentage value, I was able to find a set of parameters that worked well on timeframes from 5 minutes to 1 hour. Also, I did not use any filters, not even the ADX limiter, which is in the original strategy, so there is also room for improvement, but this is a good starting point for everyone who wants to optimize this script. And here are the top performers. First, we have the Australian dollar versus Canadian dollar on our setup. I used a 1% risk per trade compounding position sizing without fees. During the last 5 years, this version of the strategy took 750 trades, generated 127% net profit with a 1.35 profit factor and a 17% maximum drawdown. The equity curve is not the best, as the first 2/3 is a sideways/flat period, but at the end it really picked up and had an amazing run-up. The next pair and timeframe combination is the NZD-USD 30-minute chart. In the last 5 years, using a 1% risk per trade compounding setup, this strategy took 1,700 trades, generated 167% net profit with a 1.158 profit factor and a 22% maximum drawdown. The equity curve is similar to the previous one. We have a long, flat, slightly uptrending period, but at the end, the strategy had a huge run-up. Now let's see two for the 5-minute charts. For the 5-minute chart, I have to highlight that I did not add fees to the results, and as we are on a low time frame, the fee effect could be high depending on your own fee rate. First, on the Australian dollar versus New Zealand dollar 5-minute chart, during the last 5 years, using a 1% risk per trade compounding setup, this strategy generated a mind-blowing 58,000% net profit with around a 1.2 profit factor and a 22% maximum drawdown in around 7,600 trades. The equity curve is exponential with a longer flat period in the second half. And the last asset is the Euro versus Swiss franc 5-minute chart with a 0.3% risk per trade compounding position sizing. I had to go with a small position sizing to keep the maximum drawdown under 20%. During the last 5 years, the strategy took 9,500 trades, generated 465% net profit with a 1.162 profit factor and an 18% maximum drawdown. This equity curve is my absolute favorite. It has nice exponential curve without any significant pullback or flat period. Keep in mind that none of the Forex pairs had fees included, and if you are a Forex trader, let me know in the comments what your fee rates are. And that wraps up today's video. Again, you can get access to this and to all of our premium scripts and optimizations by becoming a Smart Trader tier member on our Patreon. What do you think of this script? And what strategy should we code next? Let us know in the comment section. As always, thank you all for watching, have an amazing day, and see you in the next video.